Hello, everybody. Welcome once again to another edition of Under the Macroscope, our weekly podcast catch-up with Skybound Capital's chief strategist in the London office, Jabir Sadawala. In this podcast, we're going to be talking, amongst other things, about low default rates. We're going to be talking about CEO and executive pay, a reference to food inflation in emerging markets, which was a topic that Jabir brought up in a podcast back in February as a major macro factor that we need to keep an eye on. But could I start by congratulating you, Jabir? Since we last spoke, Watford have confirmed their participation in the Premier League next season. The last time we spoke, they were on the verge. They've done it. So congratulations to you and the Hornets.
Yeah, thank you, Matt. It's a big relief. I think we've had two sets of celebrations here. The first one was around relief, and now that it's all it's all sinking in. The second one is around true excitement. We're looking forward to it. We're determined to win the championship. We've got 2 games left. Obviously, that's heavily reliant on Norwich losing both their matches, which I think is highly unlikely. But we'll certainly give it a fair shot. But it is a relief. And, full marks to the guys, because you can end up lingering in the championship for quite a few years. So to actually get back quickly is quite a result.
But I tell you what it does as well, is it just shows you how much weight sport carries for loyal fans and how much it continues to do so in these bizarre COVID times, empty stadiums. We're seeing parts of that in India at the moment. Massive debate in India with COVID cases spiking to all-time highs, and yet the IPL continues unabated. And 2 arguments. One is, how can you carry on? The other is, well, it's providing a sense of escapism and entertainment for those who can't leave their homes and needed to be locked down. So sport continues to play an important role in these times.
Yeah, definitely. Absolutely agree. And, if it's done properly, why not? I mean, I found myself glued to matches in looking at, initially being put off by empty stadiums, but then focusing on the sport. And I've come to like it.
Right. Well, enough sport for now. We're going to go on to an article that you found from Deutsche Bank on low default rates and their macro effect.
Yeah, and I thought it was a very fair point. In a way, it almost states the obvious, but it's not something that people generally are picking up on, or at least not that I've come across. And, are low default rates actually a symptom of potentially stymied productivity going forward? Because if you look at why we've had low default rates, in a way, it's pretty obvious why. We're living in a low, ultra low interest rate environment. We've had incredibly low yields. We've had non-existent inflation, and we've just had endless printing of money by governments. Really, I should emphasize central banks. And this to me is almost like another magician's trick. The magician here is the central bank, and everyone else is the audience. And by that, I include governments, because governments just have a political motive here, and they leave it to the central banks to help bail them out. And then you have the markets, made up of retail and institution. To me, ultimately, it has to pop. But we have default rates today of around 3.5%. Now, granted, that's been skewed to certain sectors more than others. Energy went through a tough time when oil prices were incredibly low. And as a result, there were a lot of companies just going to the wall in the energy sector. But I think what's going to happen now is, what happens when all that stimulus finally comes to an end, or something basically pops that bubble. We've seen around the globe how central banks have been delivering their ultimate put option by buying bonds and accepting them as collateral, good quality bonds. Also intervention in the ETF market. We've had that in Japan, which has helped with their stock market. Sooner or later, all that has to stop. And then I think you're really going to start to see proper competition. Which company can survive and which can't. There are going to be winners. There will be a lot of winners, but I think there will also be a lot of losers. They're going to have to rethink their strategies if they can. I think many of them will go to the wall before they can even change things around.
Well, companies that win are going to need good executive teams, which moves me seamlessly into your next topic that you picked up on from the Wall Street Journal, I believe. Just something around the median pay of CEOs and other executives of largely blue chip companies. I know this made you perturbed, if that's a fair word.
Yeah, it did. I mean, I've always been a capitalist. I describe myself really more as a sort of social capitalist. When I saw this, it highlighted what I think we all kind of know. And this article looked at the median pay, as you quite rightly said, of CEOs of between 300 and 350 of the biggest US public companies. Last year, for instance, the average was $13.7 million dollars. The year before, it was 12.8 million. And the year before that, I mean, 2019. And then there was a deeper study, a really deep dive by the Economic Policy Institute. And they found on average that CEOs make 320 times their typical workers. And I just looked at the table. I mean, basically, if you take the ratio of the CEO to worker realized compensation package, it's risen from 21 times, just over 21 times in 1965, to 320 times, the figure I just stated, in 2019. Now, I mean, that's remarkable. So then I was just having a look at a few other things, and you can see it largely tracks the S&P. And it just makes you think that, they're sitting on, let's say, shares and all other kinds of metrics. And that's basically how it's being done. And is that the right way? Does a market that's going up and up and up, as we've had basically since 9th of March 2009, and we've been in this incredible bull market, and for the reasons that I just highlighted earlier, in terms of productivity, should it be linked to that, or should there be some other kind of benchmark? I know it's a debate. It's not a new debate. It's been going on for some time. Maybe there's no easy answer to it, but nevertheless, these figures are startling. And also, the other thing that stunned me was, it's almost as profitable to be an outgoing CEO. Another article also mentioned GameStop's outgoing CEO, who, based on last filings, had 1.1 million shares. And they were just recently, last week, sometime, end of last week, valued at around $169 million. Not bad. I mean, that's quite a way to go. And by the way, the top earners are not just in what we might consider to be the big brand names. They are also outside the brand names. We just don't really sort of talk about them as much.
Yeah, your last point, it's a reminder of some rumblings recently about a certain football manager who it seems has earned more by being dismissed by his club than he has actually earned in managing the club. But off the sport topic once again, I mentioned in the intro, Jabir, that I think it was back in February that you shone a light on emerging market food inflation. And what that can lead to in terms of unrest. You picked up some pretty alarming figures from the Bloomberg Agriculture Index.
Yeah, so you're right. On the 14th of Feb, in my weekly and indeed the podcast we did for that one, I spoke about rising food prices and potentially the impact that this could have on emerging markets. Now, remember, in emerging market land, food is a much higher portion of home shopping, if you like, of the home inflation basket than, say, comparatively in developed markets. it's as high as 40 to 50%. It's often said that the Arab Spring, which happened from about the middle of 2010 to early 2011, was very much on the back of that. And that was an incredibly tragic event, which then spread to Egypt and other places. So then when I came across this article, it shows how the Bloomberg Agriculture Spot Index has risen, just shy of 80% year to date. And it just made me think, what kind of impact is that having in the same regions? But what's interesting is that same article, I think it also actually is, it's a Deutsche Bank one. The same article goes on to look at social unrest back in history, and what might have driven it. And in this one as well, for instance, they look at the French Revolution. So that took place in 1789, and it led to the overthrow of the old regime that we once knew, the good old emperor days. And that came after a succession of poor harvests that led to major food rises. It was a similar story, they say, in Europe's 1848 revolutions, which followed the failure of potato crops. And interestingly, the overthrow of the Tsarist regime in Russia in the 1970s, that took place also in the context of food shortages. So there is a correlation here. You probably can't say definitively that there's a cause effect, but I would say, as the old saying goes, one swallow doesn't make a summer. When you start to have 3 or 4, there's certainly a bit of a trend appearing here. And you look at what's happened around the globe, COVID and the supply bottlenecks, shortages and all of that, and we all feel inflation. I think it's impacting some more than others, and sadly it's the poorer ones as opposed to the less poor ones.
Well, as always, it's fascinating on this podcast to make an assessment of just what an impact these macro factors do have on various economies. So we look forward to keeping an eye on that. And also, perhaps ahead of next week's podcast, we'll have some more information on yet another spending program announced by President Biden in the US, which admittedly it still has to go through Congress and so on. But the stimulus, it seems, continues to come in the US, and another something to keep an eye on in the coming week. So as always, Jabir, wonderful to get your thoughts. The podcast available on Apple, Spotify, and on the Google podcast platform for Android, and all the past podcasts available at Skybound Capital's website, www.skyboundcapital.com. Until next time on Under the Macroscope, have a great week.